Passion, beauty, creativity. These are noble life pursuits. Now, what do these qualities have to do with investing? This is a story about Joe and his exploration into a better way to invest so he may pursue his passions. Joe was at a museum of art, admiring the grand Renaissance wonders of Michelangelo's work. He read that the work was patronized by the powerful Medici family. First came the banking empire, then came the flourishing of art. Joe admired his fellow musician Bono for his passionate humanitarian efforts for fair trade for profit practices in Africa. These initiatives were made possible because of his influence. Joe admires Elon Musk's grand visionary executions of Tesla and SpaceX, which were made possible by earlier successes like PayPal. These grand genius accomplishments are inspiring. Regardless of how far Joe takes his music career, he just wants to be able to pursue his own passions and his own interests. Joe is a fan of hiking, and he's noticed that when he hikes, he experiences a range of emotions, from optimism to euphoria. And when he's investing, he has similar emotions that have ranged from optimism to euphoria, and also he has seen fear and then panic. The panic does end, and it returns to optimism. In investing, we have to conquer our emotions to be successful investors. To quote Carl Jung, those who look outside dream, those who look inside awake. Joe has to decide on his asset allocation of his portfolio, and he reimagines a pie into 3 pieces: fixed income, equities, and alternatives. And by doing so, he's one step closer to a pension fund level of sophistication. To quote Leonardo da Vinci, simplicity is the ultimate sophistication. The world has changed in the past 20 years. In 1999, a 100% bond portfolio would have achieved 7%. Moving ahead 10 years, now we needed almost equal amounts stocks and bonds with some alternatives to see that same 7%. Moving closer to today, now we see we need far more equities, significantly more alternatives, and very few bonds to see 7%. Joe looks at the fixed income piece of the pie and decides to minimize this piece for the following reason. He looked at GICs over a 30-year period, where the GICs are rolled over every 5 years, where the income is spent, compared to buying the overall market, where the dividends are spent. He noticed that over the 30 years, the GIC principal stays exactly the same. The market investments grew over 4 times, and the income on the market investments grew over 5 times. During the same period, GIC income actually declined. Real wealth is created by being an owner and not a lender. For the equities piece of the pie, Joe sees that there's significant volatility short-term when investing in the market. However, as time goes on, the volatility narrows like a funnel. So by being invested for at least 3 years, preferably longer, one could reduce the volatility and therefore the risk of a portfolio. Joe was delighted to find out that there's a nature analogies to investing. Palm trees for growing dividends, the 4 seasons for seasonal rotation, and momentum rotation for wave action. Joe has heard you cannot beat the market. Actually, there is a way. By looking at the markets as if they were palm trees, they not only grow, but they produce every year. Well, similar with dividend-paying companies. If we look at this chart here, you can see on the far right, if one buys stocks that don't pay dividends, over the very long term, there's been no positive return. However, by looking at just the overall market, returns were 7.9%. And by choosing only dividend-paying companies, returns increased to 9.8. And by focusing on growing dividend companies, returns are again higher at 11.1. And by looking at the basket of growing dividend companies and focusing on certain companies like an electrical generation company, returns are again higher at 12.8. The interesting thing to notice here is that utilities are considered lower risk in the equity spectrum. So here you have the very nice combination of lower risk with higher return. Joe heard you cannot time the market. Actually, there is a way. There's seasonality in nature, in our lives, and also in investing. Joe knows he's going to get old one day, so he reflects on the seasonality of his life. Joe divides his life into 25-year increments for spring, summer, and autumn. There's only 7 years for winter since the average person lives to 82. He calculates that he may only have 708 months to live, so he may as well focus his life on his passion in music. There's a fascinating anomaly in investing in seasonal rotation that illustrates that virtually all the stock market returns occur in the winter, not in the summer. Not every year, but most years. By being invested fully in growth-oriented companies in the winter and removing oneself in the summer could add a better risk-reward profile to a portfolio. Joe has heard the market is efficient. Not entirely. There's a fascinating phenomenon discovered by academic researchers called momentum. Joe is a surfer, and he appreciates the movement of waves in the ocean. He also sees waves in his music, and was thrilled to find out it also occurs in investing. When a wave builds, it continues to build until it crests, rolls over, and then the pattern repeats itself. In stocks, some stocks trend and continue to trend at least for a while. In one example of momentum investing, here we look at 4 indexes: Canadian bonds, Canadian stocks, US stocks, and international stocks. If we look at these indexes and only invest in the top performing index of 1 month and continually rotate every month into the best performing index and follow that pattern, that beats out the simple buy and hold approach of owning all indexes equally by an astounding 63.9%. For the next piece of the pie is alternatives. And here, the approach is to find investments that are non-correlated to the rest of the portfolio to reduce portfolio risk, but still find return. Tactical asset allocation is one example of doing this. Here you could see the green line is the overall market, and the blue line is a tactical approach that is able to move assets between stocks, bonds, and commodities to reduce portfolio risk on a risk-adjusted basis. What model will Joe choose? Well, he looks at both conservative, moderate, and aggressive risk options. What is important that whatever model he chooses, he needs to stick with the system through the gyrations of the market and not second-guess the system as they are predetermined to be reasonable. Now, Joe wants to ensure his values are represented in his investing. He was happy to find out that there was a study by Carleton University in 2005 that showed there's enhanced performance by incorporating ESG or sustainability screening into portfolios. Screening may be positive or negative. An example of a negative screen may be against a company that's not up to date in its pollution control systems. An example of a positive screen would be companies that are focused on renewable energy like solar, wind, and power. Joe was delighted to see that there's quite a few options of companies that not only are in the sustainable area but also have high performance characteristics. He likes the idea of being forward-thinking and getting performance. Joe enjoys a finely aged glass of Cabernet with his friends, and he'd be open to investing into vineyards. However, someone else who, because of the alcohol connection, may decide to pass on this idea. Here we have our own values when we choose our own investments. How do young people today get ahead, especially when living in expensive housing markets? There are ways to adapt and thrive. Joe, being 23, looked at taking an assertive approach to his portfolio that returns 15% by putting in $500 a month. By the time he's 45, it's $1 million account. If instead he took a more moderate approach with growing dividends that return 10%, he would still see $1 million account by the time he's 52. And the good news is, what if he only took a conservative approach that returned 5%? He would still see his $1 million account by the time he's 67. You have seen unique ways to build and maintain wealth, so you may pursue your own lives of passion, beauty, and creativity.